Welcome to Capital Link's company presentation series.
I'm Nicholas Bornolis of Capital Link, and I would like to welcome you to Capital Link's company presentation series. We have with us today Carlos Balestra de Mottola, who is the Chief Financial Officer of D'Amico International Shipping. And we look forward to Carlos's presentation on the product tanker sector and D'Amico International Shipping. A quick note on the disclaimer that this presentation is for information purposes only. It is not meant to be any solicitation to transact in any securities, and it's not meant to be investment advice or advice of any kind. Logistics, Carlos will make a company presentation, a sector presentation, and this will be followed by a live Q&A discussion. You can submit, the participants, your questions through the Q&A button at the bottom of your screen. You can submit your questions at any point of time during our session, and Carlos will reply to them once the slide presentation is over. And in closing, this live session will also be available as an archive for replay upon demand within a couple of hours after the end of the live session. And with this, I'd like to welcome Carlos and thank him for being with us. Carlos, the floor is yours.
Thank you, Nicholas, and good afternoon or good morning to everyone, depending on where you are located. I'll share the presentation that I prepared for today. Okay. So we start with a quick stop sharing. Share again. Technical problem here. Okay. Okay, here we are. So we start with a quick overview of our fleet. We are, of course, specialized in the transportation of refined petroleum products. We have mostly MR vessels. 24 out of 36 vessels in our fleets are MR, and then we have an equal presence in the LR1 and Handy segment. As at the end of 22, our fleet was composed of 20 owned vessels, 8 bareboat chartered vessels, and then an equal number, also 8 time chartered in vessels, mostly long-term time charters and 2 short-term time charters. A young fleet with an average age of 7.6 years, 78% IMO class, and 79% of the owned and bareboat vessels, which are eco-design. We have invested substantial amounts to renew our fleet over the last few years. Between 2012 and 2019, $750 million in new buildings. Last vessel was delivered in 19 to us of this program, which consisted of 22 new buildings. Since then, we have had mostly maintenance CAPEX, but this year we had the opportunity to redeem the shares in our in the joint venture company we had with the Glencore Group for around $27 million. And it was a 50-50 JV, which owned 4 vessels, 3 built in 2011 and 2 built in 2010, MR vessels. They were bought at a very attractive price relative to today's value for these vessels, because the price was agreed just before vessel values started moving rapidly up. So this was a very attractive deal for us at a very good moment. We also have a number of options on vessels with bareboat charter in and time charter in. We will look at that more closely later in the presentation. But we exercised the purchase option on a vessel time chartered in the High Adventure at the end of last year. The vessel was delivered to us in November for around $30 million. This is the 5-year-old MR, which is worth over $40 million today. So it was a very attractive purchase price. The purchase option was denominated in yen, and that is one of the reasons why the price was so attractive, because the yen, particularly at the time we exercised the option, was very weak relative to the US dollar. We more recently exercised the purchase option on another time chartered in vessel, a sister vessel to the High Adventure, which is the High Explorer, which is going to be delivered to us around May this year for $30 million. So very similar price, also 5-year-old vessel, and also a very attractive price relative to today's value for the vessel, of course. We have quite a lot of maintenance CAPEX this year, 14.5 million. We have 9 vessels stopping for dry docks, and we also have planned scrubber installations on 2 vessels, 2 of our LL1s, which are stopping for dry docks, and that explains the big amount in maintenance CAPEX planned for this year. The amount drops significantly next year. In terms of financing needs, we have been very busy in 2021 and 22 refinancing our bank debt. We don't have any balloons in 2023 on our facilities. We do have one balloon only in 2024 for one of our LL1s, the Cielo di Londra, almost $32 million balloon, and we expect to refinance that this year at very competitive terms, and there are already some discussions ongoing with some banks. We have been reducing our daily bank loan repayments. They increased a bit in 2023 because of the refinancings that occurred in 2022, but we expect this downward trend to resume over the course of the next few years. The purchase options here on the lease vessels that I mentioned just now, they are an important means for us to deleverage our balance sheet. These are transactions where we have purchase obligations at the end of the contracts. So they are basically substitutes to the traditional bank financing. They are financing arrangements in all respects, but of course at a higher cost. When the market was not as good as today, they allowed us to raise some valuable cash, and in some cases we actually managed to raise 100% of the value of the vessel in debt through these transactions. We have been already exercising over the last few quarters some of these vessels. The High Priority was the first one that we exercised. It was also the most expensive transaction. We sold the vessel at the beginning of this year after exercising it in Q1 21. We then exercised the High Fidelity and the High Discovery. For these 2 vessels, we financed with new leasing transactions, but at a substantially lower cost. We lowered the overall cost of the transactions from just over 7% to just over 5%. And then more recently, the High Voyager and the High Freedom. The High Voyager was delivered to us in January this year, and the High Freedom will be delivered to us around April. And for the High Voyager and the High Freedom, the idea is to keep the vessels debt-free for now, given the very comfortable cash position we have. And this will allow us to reduce our P&L and cash break-even, especially the cash break-even, substantially. For every one of these vessels exercised that we keep debt-free, we are reducing our overall cash break-even by around $200 per day for the whole fleet. We are likely, if the markets continue being very strong, to continue exercising the remaining options which are still exercisable for the high trust, high loyalty, and high trader in the coming quarters, and then the Chelsea Houston in March next year. Yeah, here the time chartered in vessels which I already covered that we exercised, Adventure and Explorer. The other 4 vessels that we time charter in on which we have purchase options are also in the money, although they are more expensive options. They are not denominated in yen, and for now we prefer to keep the optionality on these vessels, but we might at a later stage decide to exercise these also. In terms of coverage, we usually aim to keep between 40 and 60% of our fleet covered through long-term contracts at fixed rates over the following 12 months. We are slightly below that. I mean, intentionally this year, we were aiming for slightly lower coverage given the very very strong outlook for the market. We were aiming to be covered between 20 and 30% for 2023. We are still at only 15%, but at a high average rate of 28,000. And that includes both the vessel that is bareboat chartered out and the vessels which are time chartered out. We will be most likely securing other vessels on TC contracts over the course of the year when the right opportunities arise. At the bottom, we see that the percentage of our fleet, which is ECO, has been rising rapidly, and it's expected to be 80% for 2023. In terms of results, well, the slide we prepared when we approved our 9 months results, we haven't updated it. We made some pretty conservative assumptions on what the rate, the TC equivalent rate could be on the 3 days. And based on that, we showed what could be the potential results for Q4 22 and also for 23 and 24. Of course, Q4 it's already over, and for those of you that follow closely the market, you probably know that the market was extremely strong, especially in December. So it shouldn't come as a surprise that we should have done better than these conservative estimates that we are showing here for the 3 days. For 2023, of course, we are only still at the beginning. The beginning of January was very strong, also because of the fixtures done at the end of last year. The market has traded down somewhat during the course of the month, but it's still at profitable levels, and we expect it to recover soon. But get this, the sensitivity here gives you an idea of what our results could look like for different scenarios for the 3 days available in the year. So in terms of costs and direct operating costs and G&A, this was also an important area of focus for us over the last few years on the direct operating cost front. We managed to achieve some pretty interesting results, and these have, after falling quite rapidly from 18 to 19, they have stayed pretty much the same level since then. G&A has declined also quite fast in 19 from the previous year, but then it has experienced an upward trend. And of course, it is unlikely that in the coming years we are going to be able to achieve the same type of results on this front because of the inflationary pressures that that most countries are experiencing today, and that will affect of course, also shipping. Here, in terms of financial strength, we ended the 9 months with a ratio between net financial position and fleet market value, which was at 42%, and the cash and the cash equivalents of $85 million. Since then, the situation has improved further. Q4 was very strong, and asset values have also risen during the quarter. So this ratio between net financial position and fleet market value should have further improved. In terms of market overview, so having a closer look at the market here, we see that the freight rates last year reached record highs for MR vessels. As I just mentioned, they have traded down a bit during the course of January, but they remain at still profitable levels. Time charter rates have been, as is usually the case, a bit less volatile than the spot rates, and they still are at very attractive levels, which are a testament to the very strong sentiment that there is still around the market prospects for this year. And therefore, an Eco MR vessel, according to Clarksons, their latest estimate should still be able to achieve $32,000 per day for a 1-year contract. Vessel values have also moved up, but they, however, remain well below the last cycle peak. A 5-year-old vessel, MR vessel, is still 23% below the peaks reached in 2008. So there's more room for these to move up. The Ukrainian war, of course, affected the trade flow significantly. We saw a very important surge in imports of crude oil, especially, and dirty petroleum products by India from Russia. They were importing less than 200,000 barrels per day, and as of December, before the war, as of December, they were importing over 1.6 million barrels per day. China was already an important importer of Russian oil, but it has, since the onset of the war, increased these imports. And with the reopening of China from the lockdowns, COVID-related lockdowns, we expect actually these imports to rise very fast during the course of 2023. Turkey was also an important source of imports of Russian oil, and they have been refining more Russian oil and then exporting more of their refined products to other locations. So these were amongst the factors which have contributed to the very strong markets. This increase in the sailing distances, in this case, mostly for the crude tankers for now, but the inefficiencies in any case, which affected also the exports of products from Russia during the course of 2022. A lot of refined products were still exported by Russia to Europe in December last year, and actually also in January this year. So we are still to see the real effects of the sanctions that are going to be coming in from the 5th of February on the exports of Russian refined products to Europe. In terms of oil supply, of course, there was a lot of fear that Russian oil supply could be severely affected following the war. This did not happen last year, but it is expected to happen in 2023, with a drop in Russian oil production of around 1.3 million barrels per day. OPEC also announced an important cut in oil production of around 2 million barrels per day at the end of last year. The effective cut in production is actually much smaller, of around 1 million barrels, because a lot of the OPEC countries were producing less than their quotas. But this should be compensated by an increase in output from non-OPEC countries, of which around 50% will come from the US, and which should lead to an overall increase in oil supply in 23 of around 1 million barrels per day. So we will see that should leave the market a bit undersupplied in the second half of the year, but nonetheless, despite the stricter sanctions that we are going to be experiencing in 23, it is anticipated that oil supply will rise this year. COVID, here we look at statistics which relate to the UK, but they're very similar for the rest of Europe. But the real story here, of course, this year is China and their reopening, as previously mentioned, which should be driving a lot more crude oil imports, and which will help, of course, the crude tankers and indirectly help also the product tankers. In terms of oil demand, despite the difficult macroeconomic scenario that the US and Europe are experiencing, it is expected to rise by a still very robust 1.9 million barrels per day in 2023, after increasing by 2.2 million barrels per day in 2022. The more impressive statistic is actually, if you look at Q4 and you see that these are the latest estimates by the International Energy Agency, oil demand is expected to end the year at almost 3 million barrels per day more than in 2022. So the increase in demand in the second half of the year is going to be very pronounced, when it is expected that there's going to be an acceleration in the Chinese economy, and also possibly in Europe and the US, following potentially a shallow recession in the first part of the year. In terms of refining throughputs, similar trends are expected, and refining throughputs should end the year well above 2022 levels, almost 2 million barrels per day more, for example, in December 23 than in December 22. So that should also be an important driver for the market this year. Product stocks are still well below 5-year averages, although they have been rising since March last year, and that explains probably why OPEC decided to reduce, cut output in November last year. It is also true that this increase in stocks in industry, refined product stocks, was also driven by the releases from strategic reserves by the US and other EIA members. So if you look at stocks including strategic reserves, they are even lower than they appear in this chart here on the left-hand side, bottom left-hand side. And so this should continue being a tailwind for the market going forward. Refining cracks are very high. Here we show refining cracks in the US for diesel and jet fuel, and they are very high relative to historical averages. And one of the reasons for this is, of course, the very low inventories of diesel, but also the very fast increase in demand for jet fuel, as China reopens. Here we have a closer look at what is happening with jet fuel demand. It rose by 17% in 2022, and it's expected to rise by 14% in 2023 by around 900,000 barrels per day. So 850,000 barrels per day. If you look at the number of commercial flights, we finally recovered 2019 levels, but this is just the number of flights. Of course, the longer distance flights are the ones which have been suffering most and which are lagging still a bit behind. And of course, they drive a lot of consumption of jet fuel, and that explains why there's still a lot of pent-up demand for jet fuel, which driving the rapid increase in demand anticipated for 2023. In terms of outlook for the crude tanker sector, I already mentioned this is going to be an important driver also for the product tankers this year. The crude tanker segment has negatively affected the product tankers through the linkages that there are between the two sectors for many years in the recent past, but this is not likely to be the case this year. The order book in the sector is at record lows of only 5.5% of the vessels on the water. Aframax and Suezmaxes have been doing especially well. The other vessel classes which seem to have been benefiting most from the conflict in Ukraine. The LCCs had a very good November, but have slipped since December, but they are still at profitable levels, I would say, for most operators. But they are also the sector which is likely to benefit most from the China reopening. It's also important to note that 64% of the LR2s are today trading clean. That is the highest percentage of the last 3 years. The last time percentage was at similar levels was in January 2020. And it's not a surprise because the end of 2019 was actually very strong for product tankers. With the very strong markets that we're seeing now for the Aframaxes, it is likely that if we don't experience a very fast recovery in the LR2 market, some of these vessels, quite a few of these vessels, could migrate into the dirty trades of these LR2s, and therefore creating a further tailwind for the other product tankers. In terms of longer-term trends, well, the demand for the transportation of refined products has been rising very fast since 2020 and is expected to continue rising fast in 2023 and 2024. COVID did accelerate the changes which were already ongoing in the refinery landscape, with a lot of the refining capacity moving east of Suez and in particular to China and the Middle East. There were a lot of refinery closures which occurred during the COVID pandemic. 1.9 million barrels confirmed the closures, and another 600,000 barrels of likely closures. Most of these located in the US, Europe, and in Oceania. The US, the shale oil industry in particular, has been a very important contributor to the non-OPEX increase in oil production. We mentioned for 23, the International Energy Agency expects that it will contribute for 50% of the non-OPEC increase in oil production. Of course, there are headwinds there. There are all sorts of bottlenecks which are preventing oil production from increasing faster, but nonetheless, it is anticipated to continue rising, driven mostly by private operators, since a lot of the listed companies have been favoring dividend distributions rather than reinvestments. The supply, we covered most of the demand factors which are helping the market. On the supply side, the situation looks just as good, if not better. The very high prices of steel have driven a good level of demolitions some time ago, but now, of course, with the very strong markets, this has dropped considerably. But at these demolition prices, of course, if for some unpredictable reason the markets were not to be as strong, it would create, in any case, an important incentive for vessels to be demolished. The fleet is rapidly aging, also because of the low level of demolitions that we experienced in 2022, as we will see in more detail later in the presentation. And therefore, at the end of the year, we had over 7% of the fleet of MRs and LR1s, which was more than 20 years old, and an order book which was only 3%, 3.1%. So this is a record low order book. And also, it's important to note that not only there is a much higher proportion of vessels which are more than 20 years old, there's a very high proportion of vessels which are more than 15 years of age, and these are vessels which have commercial limitations. They are not able to call all terminals, and as they age and overtake this 15-year threshold, they start being limited to some marginal trades, and this percentage is expected to rise fast and reach over 50% of the fleet by the end of 2024. Here we have a closer look at what happened with demolitions. 2021, Q2 and Q3 was actually, we had quite a high number of vessels being demolished, but then as the market picked up in 2022, and this shouldn't come as a surprise, demolitions collapsed, and only one vessel was demolished in Q4 22. Of course, this creates the potential for much more demolition going forward. New building orders have been subdued. They have been on a declining trend since 2018, and last year it was the lowest level since 2018. Ordered 42 vessels, and since 2007 there were only 2 years where a lower number of vessels were ordered. So this is a trend which we expect to continue, also because there is a lot of uncertainty relating to the technology which will prevail to allow us to meet the ambitious IMO and EU CO2 reduction targets. And therefore, putting all of this together in terms of fleet growth, the fleet is expected to grow by 0.6%, even with very limited demolitions in 2023, and could potentially grow by even less in 2024. Finally, just a quick look here at our NAV at the end of September. It was $611 million on a per share basis. It was $0.5 per share, and at the time we were trading at $0.24 per share, so an important 50% discount to NAV. Since then, our shares have traded up considerably, but we expect our NAV per share also to have risen quite a lot. So I believe that covers the presentation, so I'll pass it over to the Q&A. Okay, so the first question we have here relates actually to our NAV. So it's this last slide that we covered. The question is, why are we trading at such a large discount to NAV, and do we expect this discount to narrow? Well, yeah. As I mentioned, I expect this discount to have narrowed during the course of Q4. The NAV, of course, has risen during the quarter because of the very strong results that we expect to have made, and because of the increase in vessel values. But the share prices have risen considerably. Going forward, there's still room for NAV to rise, asset values to rise. As I mentioned in the presentation, 5-year-old MRs are trading at 23% discount still to the 2008 peaks. We also, of course, expect to generate substantial amount of cash during the course of 2023. I believe the discount to NAV is driven by concerns relating to the sustainability of the current market, and part of these concerns are justified, of course, because the war in Ukraine has had a very positive impact in the market. But it should not be forgotten that there are also other very strong fundamentals which are supporting the market, which I covered in the presentation now, which in particular the very low order book, and the still recovering demand for refined products from the pandemic. So with still quite an important increase in oil demand expected in 2023, despite the difficult economic scenario for Europe and the US. So I think that once investors realize that this recovery has legs and can last a number of years, it is likely that this discount will narrow further. Another question here. You are generating substantial amounts of cash. So what do you intend to do with it? What are your capital allocation plans? Do you plan to distribute dividends? Well, this is a decision that will be taken by the board and then by the shareholders. But I expect that given the very strong year we experienced in 2022, a dividend will be declared. But as I mentioned in the presentation, one of our strategic priorities is to deleverage our balance sheet, also through the exercise of the vessels that we currently bareboat charter in. And we want to reduce our break-even by doing so. So let me see here, another question. So yeah, what is your current break-even point? Yeah, well, our break-even is currently around P&L, and cash break-even is currently around $15,000 per day. They're quite aligned still. Going forward, because of our deleveraging strategy, we expect that both will decline, hopefully. As I mentioned, there are also some inflationary pressures on the G&A and direct operating costs front, but on the financial cost front, we are working very hard to bring these down. So we expect both to decline, although the cash break-even is likely to decline faster. Then another question here. Which solution do you believe will prevail as the future fuel product tanker vessels? This is a very difficult question. And as I mentioned in the presentation, it's one of the reasons why probably new building orders have been so muted over the last few years. Of course, most recently also the increase in new building prices has reduced the appetite for new buildings. There are a number of competing technologies out there. There was a lot of talk of ammonia, but ammonia as a fuel is very dangerous to handle. So I believe it is unlikely to be the winning solution for Trump vessels like ours, which have to be able to refuel in many different locations. Hydrogen could also be a solution for some type of vessels, but I believe it is unlikely going to be a solution for product tankers because of the low energy density of hydrogen. Methanol is most recently seems to be gaining some traction, especially in the container space, with quite a few vessels ordered by some important operators that can also burn methanol. It is definitely a solution which a fuel which would create less obstacles from a logistical perspective, and therefore it could be eventually the winning solution. But I would say it's a bit too early to say. In the meantime, we as a company have been testing biofuels, which is a transition solution. We have tested fuels with a 30% component of feedstock from renewable sources, and we are now moving on to test fuels with a 40 and 50% component from renewable sources. The tests with the B30 fuels were very successful, and all of our other ones already certified to burn such biofuels. So when they become more widely available, we hope to be able to use them in our vessels. Another question here, which is relating to the efficiency of vessels and indirectly to the emissions. So how do you plan to reduce the emissions of your vessels? So, well, for now, mostly we are looking at solutions which are not very capital intensive, that are quite easy to implement, proven technologies that can bring savings, each one of these of around 2 to 3% in fuel consumption, such as low friction paints, eco nozzles, propeller boss cap fins, eco torque, and of course also hull performance monitoring and optimal routing. So it's a mix of different solutions which we hope will make our vessels more efficient. For some of our older vessels, which are not still in phase 2 of the EEDI, we also have planned some small engine deratings to be able to comply with the EEXI regulations. Finally here, I think we are running out of time, but we can take maybe a last question. How do you explain the correction of freight rates in the last few weeks, and are you concerned? Well, yeah, of course, we prefer when the market is moving up or when it stays at very high levels like it was in December. So there is some element of concern. But if we look at the fundamentals, we feel relieved, because they seem to be just as strong as they were a few weeks ago, and there are some factors which we believe might explain the weakness we have seen in the market in the last few weeks. There was a very strong cold snap in the US in December, which affected refinery utilization substantially. They were from good parts of last year well above 90%, in the mid 90s%, and they dropped to around 84-85% as a result of this cold spell. But they have been rising recently again. I suspect most of the additional refined product coming out is now going catering for domestic needs, but they should soon hit export markets, because of course in the importing regions I would expect there to be pent-up demand building for these products. There was also the Chinese New Year, which came earlier than usual this year, which ended last week, and which negatively affected most likely activity in Asia. And we have seen already over the last few days that with the return of the traders to their desks this week, activity, especially in North Asia, has been picking up quite a bit. And there has been also some stabilization in the south of Asia, and some promising signs also in the AG. So we expect the market hopefully to rebound east of Suez quite soon. The Atlantic, the market is still very weak, but we have good reasons to expect it to rebound very strongly, especially as the sanctions, European sanctions on Russian exports of refined products come into force on the 5th of February. Until the 5th, Russia can export and has been exporting actually quite a lot of oil to Europe in January. So we are still not seeing the effects of these sanctions. It is also true that apparently a few VLCCs were fixed with gas oil cargoes in the beginning of this year on their maiden voyages from Asia to Europe. And that might potentially have also negatively affected the market. This is not a trend we expect to continue, because as we mentioned in the presentation, the outlook for the VLCC market is very strong because of the reopening of the Chinese economy. Finally, I would say that there was most likely some front loading of cargoes in December last year, in anticipation of the sanctions coming into force in February, and we have been paying the price of this in the course of January this year. Market.
Carlos, we need to wrap up if you don't mind.
Okay, yeah, just last comment. Market players are still very positive about the outlook. The FFA market, if you look at TC2, TC14 combined for the last 3 quarters of the year, it is still at around $36,000 per day for an MR. So, and the TC rate for an Eco MR for 1 year, as I mentioned in the presentation, is at $32,000 per day. So a very, very good levels, which are testaments to the very good prospects for the market this year.
So Carlos, thank you for a very detailed and thorough presentation, as we always give a very good presentation, and also for a lively Q&A. I'd like to thank you. I'd like to thank the participants for being with us. And in closing, I will remind everybody that this live session is going to be archived and available for access upon demand later on. So thank you to everybody, and we can all disconnect. And thank you again.
Thank you, Nicholas. Thank you.